Hello everyone, welcome to this week's episode of The Week Ahead. For those of you that are new, I'm Jennifer, a partner here at Jim Delton Trading. Jim is still on vacation, but will be back shortly. Before I forget, be sure to sign up and join us for a public webinar on Tuesday, August 22nd at 10 a.m. Eastern Time. Yes, this webinar is going to start 30 minutes after the open. Check out our sign-up link in the details below if you'd like to join us for that webinar. As you've heard us say before, what has happened before can affect what happens going forward. For several months, we have watched this market auction higher. As the auction was taking place, we have continually been uncomfortable with the underlying structure and supporting volume. The auction has consistently appeared to be driven by technical retail buying, as evidenced by the obvious adherence to the 50-day SMA. While we have observed that the 200-day SMA may capture the attention of institutional money, the 50-day is the domain of individual traders and some CTAs. While only 3 gaps remain open, the number of gaps is also supportive of emotional retail buying. The constant retail momentum buying pressured both hedge funds and long-only managers. Both July and August appeared to have been driven sharply higher by hedge fund short covering and some institutional buying. Any follower of our work has constantly heard the refrain that short covering can weaken the market. If short covering is joined by meaningful new money institutional buying, then the market may remain strong. The volume during the rally of the last several months did not show signs of solid new institutional buying. If you have reviewed or been following our last several weekend episodes, you recall that we identified Phase 1 as representing a potential auction top. Phase 2 confirmed that we were seeing laggard buyers. To review again, the diffusion model identifies innovators, early adopters, early majority, late majority, and laggards. During Phase 3, we focused on identifying the sellers. We were observing if we were seeing mostly liquidation or a more potent combination of liquidation and new money selling. The volume through Thursday's late break strongly suggested that we were seeing mostly liquidation. Late last week, for the first time, all 3 indices settled below the 50-day SMA. We had identified the 100-day SMA being approximately around the 43.50 level. Friday's low was 43.50. We still do not see indications of larger institutional money on the sell side. It is not unusual for the markets to drop by 7 to 10% before institutional money begins to get nervous. Additionally, if you review the previous episodes, we were concerned that the market may begin focusing on contagion. Late last week, this became a headline discussion. The market has turned lower and has not yet found a level where two-sided trade can take place. Markets are like any business. They are always searching for a level where two-sided trade can take place. Our focus for the coming week remains on the market's ability to hold above the 100-day SMA and establishing two-sided trade. Failure to hold the 43.50 support level increases the odds of another downward leg. Thank you for joining us for this week's episode. Our next live intensive starts on October 4th, and currently we have special limited time discounted bundles available. Because the intensive has the prerequisite requirement of the foundation and application of the Market Profile e-course, you can get a nice discount by purchasing the bundle that contains both courses if you want to join us. See the link and details below, and as always, if you have any questions, you can also contact us by phone or email. Thank you.